Hello everybody and welcome to the first video of the series. Finally, we're getting into the content. However, we'll be starting a bit more on the simpler side. I'll be talking about money basics, interest and credit, debt and loans. Starting off with cash flow. Cash flow is your active income minus your active expenses. When you're talking about cash flow, you're usually talking about a certain period of time. For most people, it's monthly. It determines your ability to invest, how well you absorb economical shocks, and your dependency on debt. Expanding on the monthly example, at the end of the month, after getting your monthly income and paying off your fixed expenses, if you're at a positive at the end of the month overall, you have a positive cash flow, and that can lead to capital accumulation. However, if you're at a negative, then that could force you to borrow. Moving on to expenses, we usually examine expenses under two categories. First is fixed expenses, which you cannot change over a short period of time. And we have variable expenses, which you usually can change over a short period of time. Examples to fixed expenses are rent and certain subscriptions. And examples to variable expenses are food and your general lifestyle. Moving on to the concept of liquidity. Liquidity is the ability to access money quickly without loss. Cash is liquid, whereas most investments are not liquid. An example is, say you have a debt you need to pay. With cash, you could pay it quickly with no loss, whereas you would have to, say you had a car or a stock as an investment, you would have to sell it at maybe not a favorable price. That would mean that you're selling it with a loss and you cannot access it quickly at the same time. That makes it not liquid. The concept of inflation. The concept of inflation is price increase over time where purchasing power decreases. That's why liquidity, in most cases, isn't desirable long term. Well, liquidity in most cases is cash, and cash loses real value over time if there is inflation. That is why. That brings us to real versus nominal value. Nominal value is the face value. For example, 100 euros will always be 100 euros. But if there's inflation, the real value of the 100 euros might decrease. That means purchasing power might decrease. During inflation, nominal value of cash doesn't decrease, but the real value does. That leads us to cash drag. Cash drag is holding excessive cash, which reduces long-term returns due to inflation. Cash drag comes with a trade-off. If you have more cash, you generally have more safety and liquidity, but you usually have less growth, even in saving accounts from banks, which is usually 1 to 2% return annually. If you have less cash, you usually get more growth, assuming you've invested that money, but you're not as liquid and you might have less stability. Next up is interest. Interest is the cost of using money over time. There's two sides to interest. You either earn it or pay it. When you earn interest, it's usually through investment returns or through loaning money to other people. And when you pay interest, it's usually because you've borrowed money, which is usually in the form of loans and credit. Now, interest is very important because it determines whether time works for or against you. That brings us over to compound interest, which is a very important topic if you're looking to invest in anything. Compound interest is interest on interest, and it accelerates over time. That means your returns on any investments will contribute to your next returns, if we're talking, let's say, annually. The good thing about it is that compound interest increases exponentially, whereas simple interest increases gradually. And lastly, credit. Credit is access to money based on expected future income. Pricing of credit is determined by risk of default, which is payments made and on time, borrower reliability, and economic conditions. economic conditions in which you borrow money really affect the interest rate that you're going to pay. That's why rate cuts are important. Credit worthiness is measured by repayment history, income stability, and existing debt. Now, all 6 of these factors are important because they decide whether you get to borrow money or not and how much interest you pay.